Welcome back to the Money Under the Mattress podcast. I'm your host, Mitch Jensen, and I'm with my co-host, Jake McAdam. And today we'll be talking about position sizing, as well as selling versus holding overvalued businesses. How you doing today, Jake?
Oh, not bad. How about yourself?
Not too bad today. Just got a few new books in from Amazon, so it's a pretty good day, honestly. Do you want to start us off and talk about how you kind of size your positions in your portfolio?
Yeah, so it's not an easy question to answer because there's a lot of different variables and factors that go into what the position sizing should be, at least like as um, starting off position size.
Mm-hmm.
It really depends actually, because sometimes like I'll put like half of what I want position size wise into it, and then wait for it to go down a little bit more. Sometimes that can hurt you because it goes back up, and sometimes it can benefit you because it goes down, right? I know I've heard of other people talk about like I think I think Phil Town on his podcast one time talked about how he does it in like kind of like four tranches, where he'll do like 25% of the amount he's willing to put into it, and then as it goes down. Um, I think that's a little excessive,
Mm.
because at that point you're kind of just like betting that it'll keep going down. And if you're that strong about it going down, then like why are you putting it in? Like I don't know. It's kind of iffy for me, but I think that I'm probably better off most times just putting it my full position in, and then if it becomes super cheap and it becomes a lot more attractive than another position I have, maybe trim another position or fully exit another position and put it into the position, the new one that I have, right? But yeah, it comes with a lot of like opportunity costs.
Mm-hmm.
What do you think when you're?
Yeah, like I mean, for my personal portfolio, we have a similar portfolio, I'd say, Jake. Fairly similar.
Yeah, there's a few positions that are different and a couple different sizings within the actual
Yeah.
companies, I think, but pretty like for the most part, there'd be like maybe like a 70% correlation probably between the
Yeah.
portfolios, I guess you could say.
Yeah, because we talk daily, so it's pretty hard to have a really strong business and not talk about it or not have another person invest in it. Um,
Yeah.
but yeah, like my position sizing isn't like a simple one. I'm not sure if I'd even be able to explain my position sizing. It's more like a kind of feel out. It all depends on the investment.
And sorry to cut you off there, but and it
Mhm.
depends. Like it also depends because we have other sources of income coming in. So we have like different flows of capital coming into our portfolios where, like, if we don't find anything attractive for like a few months or like sometimes even a year,
Yeah.
then like we'll have a bunch of cash to put into like our next best idea. And then sometimes we find like a few ideas like right in a row, bang bang, and then we have to like think of it a different way. So it really all depends because we have a bunch of cash coming in, right?
Yeah. Um, but for me and you kind of have a similar portfolio in the sense that we have businesses that are long-term compounders in our opinion. And then we also have ones that are just like stable businesses that we think are undervalued at the current time. And it's going to maybe 1, 2 to 3x. And then after that, we're out. Like we don't think it's going to be like a long-term hold. Um, so
Yeah,
one business that comes to mind for that is like Seritage Growth Properties. We believe the intrinsic value is somewhere between $40 to $45. We bought it back at 9, 10, $11 a share.
yeah.
If it goes up to probably 35, 40, then we'll be out compared
Ye-
to um, like an equitable bank. Um, we believe that one's current intrinsic value
like
is
an
around 200, but we think that's gonna be a long-term compounder for us.
or like an Alibaba or something, right? That we think is going
Yeah.
to compound for many years to come. But the thing is, though, with like Seritage, with their new CO and like kind of a little better explanation on their strategy,
Yeah.
they're densifying like densification on some of the properties, and like it's really hard, I find, to like I can't put a precise number. I mean, most times you can't, but like I can't even
Yeah.
like really like it could be worth a lot more in 10 years from
Yes.
now if they're able to execute.
And
Like
so
we're
that's
thinking of it as like this is what it more than likely could like execute like fairly reasonably, But like
Mhm.
if they hit a home run,
On
I
on
think it
some of
could
the real estate development, yeah.
like I think in 10 years time you're looking at like north of like $90 a share probably, if not more.
And I believe Monish Mabrai has a similar thought on that too, is that he bought it as a business that was on fire at the time, a big fire sale. And so he bought it thinking that he might one, two, three, or four X his investment.
Yeah.
But now I think that we have this new CEO. They're starting to have better properties, um, do some redevelopment plans that are actually helping the business out, both
And
long term as well as like in the short term too.
did you listen to like the latest like little like interview she had? It was
Hmm.
like her and like the CFO and then some guy interviewing them, and she said that
Yep.
before with the old CEO, he kind of just sold it off as like they need capital. But what she
Yep.
kind of wants to do, I think, is sell off stuff like identify now what they don't want to keep,
Hmm.
sell that off now and get rid of it, and then just focus on the stuff they want. Which
Yep.
I like more. I know that some people are like, oh, like they're destroying value. Like some people could take that the wrong way.
Yep.
But I think it's smart to do that because it's kind of dumb to keep around properties that aren't producing anything and are like costing you stuff, if anything. It's better to just get it off and then get it in cash and then put it
Yeah.
towards something that you want instead of
No,
like dragging
exactly.
it through the mud and, you know, yeah.
In other words, it's similar to like, would you rather have like 40 crappy cars, or would you rather have like two to three really nice cars? That's kind of
That
what it's like.
that and if a property is losing you money every year,
Yeah.
where
No,
you could
exactly.
get like maybe you could get like a certain amount of cash for it right now, it's better than having something that's losing you money every year.
Hmm. Yep.
So, and then put it towards something that you see, like you said, where like you could have a couple good properties.
But yeah, so like going back to like the position sizing, how um my initial investment on Seritage wasn't like a massive, and like I think it might have been 15%, which is sizable, but like in the portfolio, I think a sizable position for me is probably a third of the portfolio. Um, and so since we thought it was kind of like not a not a great business, it was kind of just an okay business.
With a
We
lot
weren't real
upside
there's a lot of upside, potential downside, but it
was
was an all right
limited.
business. Yeah,
It had muted
exactly.
downside. I found there was muted downside just because of Berkshire holding the debt
Hmm. True.
and the way they don't usually drag people through bankruptcy and a couple other things. And just the fact that they had like the straight like value of the properties and like the prime locations that we thought they were in. Like, yeah.
So I'd say like the higher quality businesses, I'll position a lot higher than just like the regularly okay, half decent businesses that are just selling. Um, they're just on sale for a little bit. Um, like, is that kind of how you position your portfolio too? Like, you position your higher quality businesses that you think there's gonna be long term compounders higher up than you would for just a stagnant business such as Heritage back when we thought it was.
Like for my position sizing, I know some people like Manish used to talk about doing like 10% in 10 different companies
Yeah.
or but realistically like that's just not like how if I had a more like permanent portfolio where cash wasn't coming in or out type of thing, like I don't have any cash coming out but I have cash coming in,
Mhm.
it would be a lot different. Like I'd probably do it differently, but right now like I just kind of think like how much cash do I have on the sidelines, how much cash will I have if within like the next year from other sources, right, of income. And then I think, how good is this company? How likely are we to lose money and how much money versus the upside? And I know Warren and other great investors talk about the downside protection. And I think that is very important. Um, and you got to think about what is protecting your downside. And if you can figure out reasonably what your likely downside is, and if it is muted and there's some asymmetry there, uh, you know, I'm willing like with Alibaba,
Hmm.
it's 33% of my portfolio right now.
Okay.
And that's like the most I've ever had in one business so far. like as
Hmm.
allocation. And I'm not saying that like for a starting position, I probably wouldn't ever put more than probably 40% of my portfolio in it.
Yep.
But I'd be okay with, let's say, Alibaba in like 5 years from now runs up to like, let's say, for some reason, 75% of my portfolio. If
Hmm.
I still think, if I at that price, if I still thought Alibaba was an attractive company, I wouldn't trim at all. Like
Yeah.
I'm okay with letting my winners ride and letting it become like a majority of the portfolio. Like I'm okay with that.
Yeah. I mean, to kind of go back to a conversation that me and you had earlier on this week, um, since we're having additional income coming into our investment portfolio, our personal portfolios, you thought I was thinking talking about my position sizing in Alibaba and how much I should position it, as I do believe that is a tremendous business and it's selling at a half decent price, tremendous growth potentials in the future.
It's huge
We'll,
tailwinds, yeah.
yeah, we'll go into it later on sometime. But um, you talked about like the future. What's your future cash position going to be like in a year's time, and position it off that instead of what your today's cash position is,
Yeah.
um, which kind of made me think like, okay, that is something that I didn't really think of beforehand. Which then,
Because
yeah, you go.
because one of the things I told them was opportunities don't always come around at good times when you have cash, right? So when there
Hmm.
is a good opportunity, you need to take advantage of it. Where in a year's time he could wake up waiting for another opportunity. Like let's say you put like less than what he should be putting in Alibaba now, and in a year's time he collects all this cash, he could have no opportunities and he just keeps collecting cash. So it's better to put money into opportunities you have right now rather than wait for a better one in the future. You can always
Yeah.
just trim from Alibaba or another position in order to take on a new opportunity in a year's time. So I just said like in a year's time, your portfolio will be dominated by cash because you already have a half decent cash position plus the income coming in. It will
Yeah.
dominate your portfolio.
No, I think like right now, currently, I have a fairly big cash position of 35%. And probably by the end of the year, it could be upwards of maybe 50% if I didn't buy anything. So yeah, I don't like to have a 50% cash position. So yeah, I'm gonna have to make bigger bets, which I started with Alibaba. Right now, I've got a 26% bet on them, and I'll eventually get probably a little bit bigger of a
I've
position on them.
I've thought about I actually contemplate this quite often, or like lately at least,
Hmm.
about making Alibaba a bigger position even. Because I think about like how much money because like we're both pretty young in
Yeah,
our earning careers, right? And if we think about like the more you think about it, the more you're like, as time goes on, like the money that we're putting in Alibaba right now will be nothing compared to the future.
yeah,
So it's like when you see like great potential within uh, a security, and that let's say that how do I put this? When you see great potential and there's a lot of cash coming in future years, you can't think in like a traditional like stagnant portfolio terms, I guess you could say, in a way. Like you can't think of it as like, oh, like it's crazy to put 50% of your money into this one position. But like that'd be different if you were like 50 years old and you were getting ready to retire soon or something, and you weren't contributing much money into it, or if you were even contributing it wasn't really moving the needle because like by then your portfolio is probably grown to, let's say for example, $5 million or something, right?
hmm
And let's say you're contributing like 10-15 thousand a year to it, it's not really going to move the needle. Whereas when we're younger and we're contributing to it, we haven't had enough time to compound it yet, so we're able to probably make bigger bets because we have more cash coming in. But that doesn't mean we throw out the whole like making sure that you're
yeah. We're
protecting
not
your downside
YOLOing on
stuff.
Tesla calls or anything like that.
No, not
We're
at
still
all.
making very, um, yeah,
It just adds another layer of extra like margin of safety, I guess you could say, in a way. Like it adds that extra layer.
I mean, it's not an extra margin of safety, but it just feels more secure.
Yeah,
Um,
I don't know how to like even, I don't know
you're
what
able
the
to sleep
term would
better
be.
at night, I guess. I mean,
I
I
sleep
sleep
good no
pretty,
matter
yeah,
what.
I sleep good pretty well right now, but
I'm sleeping great.
sleeping like a baby.
Yeah.
Um, I guess we're going into our second topic, which is selling versus holding overvalued
Ooh.
businesses. This is something I had to just deal with yesterday, actually. I had a position in Micron Technologies, the semiconductor business, for probably like the last year. Was it, Jake? Give or take the last year?
Yeah, we'll call it 9 months to 12 months, somewhere in between there.
Yeah, something like within there. I bought them at an initial price of $42, and I just sold. I've been cutting when they hit around
Almost
like
100.
$95 or something like that a share. I cut half of the position then, and then I just sold the position yesterday at like $85 a share. Um, but the reason that I sold is based on the fact that I'm starting to understand better businesses than Micron, such as EQ Bank as well as Alibaba. I understand them a lot better. Not saying that I don't understand Micron, but just when prices go up drastically within a short period of time, and you are talking about cyclical business in the short term, it gets pretty foggy of how overvalued or even fairly valued the actual business is. And so that's when you look at the opportunity cost of that capital going into other investments such as EQ Bank as well as Alibaba. And so, yeah, I had to pull the trigger yesterday on Micron,
It
and
was I think you mentioned to me, Mitch, where you said like back when I did invest into it, like
mhm.
or when you invested into it, you said that at the time you knew that there was a lot of like potential upside in this and that like chip prices weren't like fully like over like it wasn't like chip prices weren't like high in historic relation, I guess you could say.
Mhm.
I think you said, and then you also said how like there's more upside than downside at this point. And then we
Yep.
saw a couple other bigger players getting into it, like Li Lu and these guys, and Monish was in it. And but the thing was, is we didn't. It wasn't one of our more well known. Like we didn't really understand
It wasn't like a
the business as
strong
well.
conviction. It was a strong
Yeah,
conviction at 42. It's not a strong conviction at 85.
it's one of those things where we couldn't predict like whether this was like a secular trend that would continue with the chip
Yeah.
prices and stuff, and like how that would work. So in it just wasn't something that I felt like I even talked it through with you. I was like, do you like it more than Alibaba right now? Do you like it more than EQB right now? Do you like it more than like other ones? And I said, do you
Hmm.
understand that the other one's a lot better? And we walked through it and we figured out that we knew the other businesses a lot better than we knew Micron.
And we had
And
a stronger conviction of their intrinsic value compared to right now. I think Micron's intrinsic value is anywhere between upside of 20% to downside of 20%. Like I think it's kind of fairly priced right now to overpriced. Um, but
we could be
like,
totally wrong on that though,
but I
because
could be
we
totally
like
wrong on it, and I'm just kind of taking a shot in the dark just on a half decent educated guess from just reading a couple of their
rather
latest
than
reports and stuff.
rather than saying like we didn't really understand, we understood it, or at least I didn't, but you did. You understood it,
Hmm.
but you didn't have it wasn't predictable enough for you to like see it within the future. Like you couldn't really see like any clear future of like what it would be in like 5-10 years from now. Like you just can't see that. At
Yeah,
least we
I didn't
couldn't. There
know.
might be someone
I
out
don't
there
know
that
where the
can.
yeah. Like I think there's a lot more smart people out there than me on microchip, the whole microchip shortage, as well as the demand and supply of microchips. I couldn't tell you what the next 12 months is going to look like for the microchip business,
Let alone
and
5 or 10 years.
let alone 5 or 10 years, right? I believe 5 or 10 years, Micron, yes, will be a bigger and better business than it is now. Um, but I also think EQ Bank as well as Alibaba is going to be a lot better business, and I have a stronger
And
conviction on those.
in another thing, I think is it, it just seems like a very cyclical industry, right? Like it feels like a very cyclical industry. Um, it seems like things are going great right now,
Hmm.
and I think it's better to get out on a nice gain
Yeah,
when things are going great rather than try to push it, I guess. Because we're not really good at timing. Like we're not good with the cyclical industries.
No.
Um, and I think it's just better to get out when times are good.
And it's similar to back a couple episodes ago when we talked to Alex Morris from The Science of Hitting, and he talks about his Microsoft initial investment in 2011, and then towards kind of now where I guess you could kind of call it overpriced or it is very fairly priced. Um,
Yeah,
and so he says, like, I mean, don't quote me on it. I believe what he was kind of entailing is that his Microsoft position now, I think, is like just under 20%. And so we're like, are you thinking about cutting or maybe even selling? Like, what type of business would it have to be? And he said it would have to be a really incredible business based on the fact that, let's say, if it was just a stagnant business that he got into, like he saw this business come up and he thought, okay, this is a margin of safety of 50%. As soon as it hits a double, then I'm out.
yeah.
Then what does he do with that cash? Right? Compared to he sees Microsoft as a really good business where potentially in the short term it might go down in value or in price, sorry, of the stock, but he thinks in the long term it is a really good business.
Oh,
And so it's kind of like going back to my Micron, where Alibaba as well as EQ Bank are very long term compounders for me, compared to Micron, where if it did shoot up, let's say an extra 50%, and Alibaba and EQ Bank shot up 50% or so, then I'd be kind of like, what do I do with that cash? And so,
well, it's just like us when we bought Boston Omaha back at
mhm.
$16, and I think it was like October, November. Well, do you remember what day it was? It would have been, I
Must
think,
have been
was it
October.
October or November, one of the
Yeah.
days, like one of those months. And when we bought it, we kind of like thought like, oh, this is like interesting. How we learned about the business
Hmm.
and we learned about like the management. And we thought, yeah, like this, we think this is gonna be a long-term compounder. Like we didn't expect it to go up as quick as it did,
No,
and then it tripled on us. So like we had a 200%
it
gain on
tripled
it
on us, I
pretty
think, within
quickly.
3 months, some of that.
Yeah, like really quickly. And normally, a lot of value investors and stuff would probably sell that real quick. But we said like we think this has the potential to compound for years on end. And we were betting on the jockey type of play with the management
Hmm.
team. And after that, it went down. Now it's only up a double. So I think it lost about close to, at one point, it lost like a little over 50% of its from its peak. I think it was down.
Yeah. It was around
And we,
$50 and then it dropped down to about 25,
yeah, like even maybe a little bit lower. And but now it's
mhm.
at like what, 30 something right now.
30 some change.
So
Yeah.
yeah, so we still think that long term that's a great business. And I'm glad we never sold, even though it was a quick gain. Like I'm glad we never
Yeah.
sold. But the thing is like people are like, oh, when it gets to this P, you got to sell out of like the company, or like when it doubles. And like we always, when we first learned about investing, like I know at least I did. When I first started learning, I was learning a lot from Phil Town,
Hmm.
which is like he's a good guy to like kind of get some basic fundamentals from about like value investing, like kind of like learn like he introduces you to like pretty slowly, like as a beginner. But then like as I learned from like other people and like read a lot of like other investors, I realized that like the best investors in the world are the ones who like identify a long-term compounder and they just sit on their hands. They just
Yeah.
sit there and they let it compound and they don't worry about it getting like a little bit overpriced or even like a lot overpriced. Like Money uses the example
Just
about
sitting in the
Walmart all the
backs.
time. Like he uses that about how like the Walton family just sat on their hands the whole time. Like some of the best investors in the world are like founders of these
Bezos,
big companies, right? Because they just
Zuck. Yeah.
concentrate on one business, made it a great business. And I think that a lot of people like Phil Towns, these guys, they'll sell out of it way too quick. Like they'll identify a great business. It's not like they're buying crappy businesses. Like Phil Town advocate is an advocate for buying like great businesses when they're at like good prices, right? But you would
Hmm.
think if he was buying a truly great business that he wouldn't sell once it becomes fairly valued, right? You'd think that he would say, okay, great, like I double my money, it's fairly valued now. I'm just gonna let it compound for me and let it go and just keep tracking the business. If the business gets better, hold on. But that doesn't seem like what he does. Like he seems to sell once it gets fairly valued. But I don't know. Like
Hmm.
it'd have to get egregious for me. Like I'd have to like think about it. But like let's say something was you thought was gonna for the next 10 years. Like let's say you bought into a company, and let's say when you bought into it, you had the expectation that it was going to grow at like 15 to 20% a year for the next, say, 5 to 10 years or something, right? We're going to throw out some numbers.
Hmm.
Um, and you bought it, let's say, like, I know, we'll put a 15 PE because it's a stock that's growing, right? And you said, okay, at 30, it's fairly valued. And within a year, it hits 30, it doubles on you. And normally they would advise, like Phil Towns or someone else like that would advise you to sell out of it. Well, I think I think that, like, if it's still going to grow at a good clip, I don't think it's smart to sell out of it unless you have
Yeah.
another opportunity that's better. It's all about seeing what's better. Like, do you think it's better to hold cash at that point than just hold the stock until something better comes along?
At that
And
point, you're kind of just timing the market. That's
you're
what you're
time the
trying to do, is
market.
really trying to time the market. I mean, if you're gonna, let's say for example, if it does go up to 30 PE that your hypothetical business does,
Yeah.
and then you see maybe a better business than that one
Hmm.
that's selling at cheaper, um, or selling at a half decent price, then yeah, okay, maybe you want to sell it or cut a little bit of it and go into the other business. But no, I don't think I'd want to, if I had a 5, 10, 15 year time horizon on this 15 to 20% CAGR stock, why would I want to sell out just based on the fact that it might be 25 or 30% overvalued?
Yeah, and it's like it just amazes me that people will put like this like number. They'll like put a number on what they're gonna exit at, and this makes no sense to me. Like, if you actually truly looked at yourself as like the owner of that business and thought about it, you would think really hard about selling that. Like, if you were the owner of this business, would you sell at that price? And then if you were to sell, what would you do with that money? And like, it's not easy to like sell a business and then have another one ready to go. Like, it's not like, to have great ideas come across, it sometimes takes a while and a lot of digging to find like a good idea. And you're better off just holding great companies. Like, if you think the company's getting better and then you think like management's good, it's hard to leave a great company for a company that you don't know as well. Because I find, like, you know how the saying goes, like, you only really understand and like know about the company once you buy it. It would have to be like a substantially better investment opportunity for me to leave like a company that's fairly priced or slightly overvalued. Like, it would have to be something like egregious, like a 70 PE or something, like 60 PE, something really like ridiculously overpriced for me to like leave and just put it into like another opportunity that wasn't like,
Yeah.
yeah, anyways.
I mean, an example I guess I can put out there. I'm not sure if it'll work or not. Um, but let's say, you're in the city, a regular city that has a lot of water in it, and it's just a regularly warm day outside, right? So you're gonna go in, you get your bottle of water for, let's say, $2. Okay. So the price of that water is $2. And if somebody on the street came up to you and said, "Hey, I'll buy it off you for $5," when there's so much more water out there, you're like, "Okay, yeah, I'll sell it to you for $5. I'll go and get a new one for $2 and make $3 off that." But let's say if you're $2 bottle of water and you're hiking the Sahara Desert, there's no water around. That $2 bottle of water, that same guy comes up to you for $5 with $5 and says, "Hey, I'll buy another water off you." The odds are that you're not going to sell that water for $5 anymore, based on the fact that there's not enough supply, and that's just kind of like the example I have, is that when there's good opportunities around there or very similar opportunities, such as the water bottle, then yeah,
Yeah.
you might want to sell the water bottle for $5 within the city. But then when there's not a lot of opportunities for that water, let's say when you're in the Sahara Desert, you're not going to sell that bottle of water for $5.
It's all about replacement. Like, there's
Mm-hmm.
just
Just
sometimes there's
opportunity
a lot of
cost.
sometimes there's a lot of replacement. It's better to have higher turnover sometimes. Sometimes
Yeah.
that's a great thing, but a lot of the time it's probably not good to be turning over frequently.
No. Plus, then you can go into like the whole topic on taxes and stuff like that.
I
Um,
think the more you try to pick great businesses, the less you'll pick.
yeah.
It's weird. It's kind of like the opposite of what you think. Like, people think that the more stocks you have, the greater chance of you nailing a great
Hmm.
business. But I think it's like the opposite. You just run the chance of like leaving a great business for a not so great business
True.
if it's already doing
Um,
great. Anyways,
do you want to talk about a third topic that you want to discuss
yeah, a
today?
little bit about owners' earnings.
Yeah.
Yeah, I think that's really important. I hear a lot of people talk about like free cash flow and how like that's important. And obviously, on more mature companies, a lot of owners' earnings and free cash flow will be pretty well the same thing. And then, but on like a lot of younger companies that are growing, owners earning some companies that are growing don't even have free cash flow, but they'll have a lot of owner earnings. And then like I kind of like got thinking, and I was like talking to you about this today on how like when you look at like cash flow from operations, two companies could have like $100 million each in cash flow from operations. And then once you look at their capital expenditure, you can notice that both of them have like zero free cash flow. But if you dig into each company and you figure out how much like capital expenditure that's maintenance versus growth is, and like say company A has 100 million in cash from operations, but that 100 million is put into maintenance capital, then really like you're not really providing much value. Like that company's not really providing much value. Where if you have like, let's say company B has 10 million of that 100 million in maintenance capex and the other 90 is going into growth, then it's kind of like they're going to grow the company, right? So I really think it's important to figure out like how much of the capital expenditures are maintenance versus growth, and that it's not as simple as just looking at how much free cash flow every year it produces. And don't get me wrong, free cash flow is really important, especially when you get down to like the more mature companies and if they're able to produce like free cash flow for dividends, buybacks, paying down debt and stuff like that. But you some companies will like destroy value and you don't even realize it, where other companies are creating value and don't even realize it. And for people that don't really understand maintenance cap versus growth cap, if you think of it from like a rental property, maintenance capital on a rental property, if you own like, let's say you own a duplex rental property, and maintenance capital would be like replacing a roof, replacing a toilet, painting your walls and stuff like that. Basically just maintaining the property in order to like keep its position where it's at, like its competitive position where it's at, where growth capex would be like adding another unit on, so turning it into like a triplex. I think it's called triplex, yeah, and being able to like grow your amount of rent that you can produce from the property. And then like an acquisition would be kind of like buying another rental property. So like there's like different things. Like I've seen people, which I find kind of weird, incorporate in free cash flow, like they'll take out like acquisitions, which I find kind of weird because I mean, like maybe you could include it if that was part of their strategy of like doing acquisitions every year. Then maybe you can include it, but for the most part, like I find it kind of strange. Um, but yeah, I really do think it's important to look at like how much maintenance capital is in the companies that you're investing in or looking to invest in. And sometimes, like as Buffett says, it's not easy to tell how much maintenance versus growth is. And if that's the case, you probably shouldn't invest in the company. Sometimes management will lay it out there. How much is maintenance? It is rare, but sometimes they will. Um, there is a way to figure it out, and sometimes you just kind of have to estimate because you don't really know like the precise figure. But with investing, um, there's never really a precise figure, especially when you're evaluating the business and you're projecting out stuff. You never really know what it's going to be. That's why it's important to have a margin of safety when you buy something. But yeah, like I think it's really important to figure out what maintenance capex is versus growth. Do you ever like what's your take on that, Mitch?
Mm, pretty much just the same as you. Like, there's not, I don't know, like, I don't really have like a
What?
different take, to be honest.
Because like the way I think about it is like I could be like oversimplifying it and like you could get deeper into it, but like the way I think about it is that, like if I had a rental property and every year, let's say I made like $100,000 before like maintenance costs and stuff like that. Let's say $100,000,
Hmm.
and every year I was putting like, okay, so let's just, every year I had to put 90,000 back in for maintenance. Really, you're only making like $10,000 a year, versus like if I had like another property that I was using that only required like $10,000, like the opposite, and I had 90,000 to either acquire another property someday or um, put another unit on. It just makes no sense, like, to me, why people don't like think about that, and people like just use like reported gap earnings and stuff. I,
Yeah,
I find it weird. Anyways,
true. No, I don't really have like a different opinion on it than I would say you do. Um,
because people could have like, what's funny is it could say like it has earnings and like you're getting cash flow from operations,
mhm.
but then you have like, you could have the whole property needing maintenance every year of $100,000, and you're not making any money from it really. Like you're not producing any cash that comes back to the owner. So it could just be a big like accounting. I don't even know what the word is for it, but like it could just be a big, I don't even know what I could call it, but I think it's just really important to figure that out. Like I really do. I think that's one of the more important things that a lot of people don't look at. And they kind of just like glaze at the numbers and think like, oh, it says like, you know, cash on operations here, and then like there's no free cash flow. Like this is a bad business. But with a lot of like,
Like an accounting
again,
maneuver
companies,
would it
I
be
guess
like
it's
just
an account. It'd be like, it'd be kind of like, it could be a manipulation of accounting by the corporation, or it could just be how the business is, and people could mistake it, right?
mhm.
And I think it's also important to like figure out like what they're doing with that growth capex, and like try to figure out within the financial statements and other material to figure out like what they're actually doing, like what maybe they've done to maintain the business, or like what they would have to maintain business,
Mhm.
or versus like what they're doing to grow the business. And then you get to see like how much at the end of the year they're gonna like be able to buy back shares, or like what they're gonna do with the cash. Because I think you got to follow the cash. I think that's a very important thing, to follow where the
Yeah,
cash is going. Because if you got a bad management team, it usually shows up within the financial statements. It's not always that clear, but most of the time you can tell.
true. Well, uh, I think that's it for today's podcast. Anything else that you'd like to add today, Jake?
No, I think that's great.
No. Well, thank you everybody for listening till now. Um, if you'd like to follow us on Twitter, my Twitter is Mitch Jensen _. What's your Twitter, Jake?
I think it's at Invest Condensely.
All right. And then we're posted pretty well daily. And um, if you want to see like the show notes and stuff like that, it'll be on Twitter. So thank you very much, everybody. Thank you for listening to this episode of Money Under the Mattress. If you have any questions about this episode, you can email us at moneyunderthemattress.podcast@gmail.com. Everything discussed in this podcast is our opinion and should not be used as investment advice. This podcast is for entertainment and education purposes only, and hope you enjoyed it.